Brian Cordes, head of the Portfolio Specialist Group here at Cohen & Steers. The first half of 2021 has been a strong one for REIT performance as the asset class has benefited from the vaccine-driven recovery, where we are in the economic cycle, and an appreciation for the relative value that the asset class has exhibited. It's also been another year where many active REIT managers have outperformed their benchmarks, a continuation of what we've seen both over the short and longer term. Whether you look at 3, 5, or 10-year annualized periods, the majority of REIT managers have demonstrated the ability to generate excess returns. And the percentage of those that have is far greater than what we've seen from large, mid, and small cap equity managers. This active advantage that REIT management teams have demonstrated, we believe, can be explained by 3 factors. 1 is focus. 2 is their ability to capitalize on some of the dispersion of returns we see from property to property type and country to country. And 3rd is their ability to take advantage of valuation opportunities created by an inefficient market. First, focus. We do believe that one of the reasons behind the active advantage is the amount of time and resources real estate management teams devote to understanding the real estate fundamentals. For example, at Cohen & Steers, our global real estate team is made up of 22 investment professionals with boots on the ground all around the globe, dedicated to real estate investing day in and day out. In addition, we may, in a typical year, conduct up to 300 property tours, 1,300 meetings with management teams. We'll also meet with independent brokers to gain a local perspective and, of course, leverage a vast amount of proprietary data as well. This focus and attention to the asset class can lead to potentially higher quality information, more accurate forecasts, and the ability to implement investment decisions faster. Second is capitalizing on the dispersion in performance we can see from property to property type and country to country. Today, the global REIT universe is made up of 17 different property types, spanning dozens of developed and emerging markets. Each of these property types will have distinct characteristics, different lease durations, different tenant types, and will also perform a bit differently depending upon where we are in the economic cycle. The same can be said from a country or regional standpoint, where quite often they will all be experiencing something a little bit differently at any given point in time. And what this has led to historically is a very wide dispersion in performance across the property types and regions. For example, in 2020, with COVID-19 leading to lockdowns and social distancing measures, it brought about new behavior, some of which benefited certain areas of real estate, such as data centers, industrial warehouses, and self-storage, whereas others, it negatively impacted their businesses. In fact, hotels and office and retail REITs were some of the most negatively impacted businesses in all of the economy. And this led to a very wide dispersion of return. In fact, the difference between the top performing property type and the worst performing property type, the differential was 58 percentage points. But this is not abnormal. Looking at it on a year-by-year basis over the last 5 years, the average dispersion between the top and the worst performing property type has stood at 49 percentage points. It's this, again, attention to the characteristics and the fundamentals of what's happening in the various property types and countries that can allow active REIT managers to emphasize allocation to the areas they believe will outperform and underweight or avoid altogether those areas they expect to underperform. Third is taking advantage of valuation opportunities created by an inefficient market. Over the long run, REIT performance will be driven primarily by the value of the real estate itself. But in the short run, because they are equities, they can become dislocated to the value of that underlying real estate. And one of the main reasons for that is the generalist equity managers do not devote a lot of time or resources to the real estate asset class, because real estate only makes up 3% of the MSCI World Index. This lack of in-depth analysis, combined with the fact that general equity managers and passive vehicles do have a high level of ownership in REITs, can lead to potential pricing inefficiencies that REIT managers can take advantage of. So as investors look to allocate to real estate, we believe it's for these three factors that active REIT management may potentially lead to better investment outcomes.